Think back to the year 2000. That screeching AOL dial-up tone filled the room. Napster was how we found music. And in college dorms, kids were coding websites they swore would make them rich. The internet felt unstoppable. Companies with no profits were suddenly worth billions. New stocks doubled on the first day they went public. Everyone said, this is the new economy. Stocks can only go up. But then, it all came crashing down. The Nasdaq, which had soared to 5,000, lost nearly 80% of its value. In just 2 years, trillions of dollars were gone. And it wasn't just speculators or tech dreamers who got crushed. It was people on the edge of retirement, men and women who had spent 30 years saving, watching half of their nest egg vanish almost overnight. Futures they thought were safe, gone. In this video, we are pulling back the curtain on the dot-com bubble and revealing the little-known strategy that wealthy still use today to shield their wealth while everyone else is left holding the bag. It didn't feel like a bubble. Not in 1999. It felt like a breakthrough. America was firing on all cylinders. Unemployment was low, inflation was tame, and in Silicon Valley, the future wasn't approaching. It was already live. They called it the new economy, a digital world where rules didn't apply and gravity didn't matter. Startups with no profits, sometimes not even products, were going public overnight. And Wall Street, they couldn't shovel money in fast enough. The Nasdaq didn't just rise, it erupted. From just over 700 in 1995 to 5,048 by March 2000. Everyone wanted in. College kids, day traders, yuppies. One-click trades on E-Trade replaced pensions. Stock splits were celebrated like birthdays. Eyeballs are the new earnings, analysts said. Click-throughs are the new cash flow. Pets.com raised $82 million selling dog food online and burned through it in 9 months. Webvan raised $375 million to deliver groceries and filed for bankruptcy less than 2 years later. And Cisco, a company selling routers, became the most valuable corporation in the world. But nobody blinked because the belief was louder than the numbers. The internet changes everything. Valuation doesn't matter. Only vision does. CNBC kept the score. IPOs were the highlight reels, and every portfolio felt unbeatable. People weren't buying companies. They were buying dreams. And the market priced them like they already conquered the world. But beneath the euphoria, earnings were stagnating. Debt was piling up. And insiders, the ones who built the dream, they were making their move towards the exit. While the crowd was still dancing, the fire alarm had already gone off. The collapse didn't feel like a crash. Not at first. It felt like a slow leak in a pressurized cabin. Silent, invisible, and then explosive. March 10th, 2000. The Nasdaq hits 5,048. Tech stocks are untouchable. Analysts are euphoric, and no one wants the party to end. But behind the curtain, insiders begin cashing out. Earnings reports start to wobble. And the air, though still warm, begins to shift. March 13th. The Nasdaq dips slightly. A shrug. Nothing serious. The crowd calls it a healthy correction. March 20th. Oracle misses earnings. Cisco stumbles. Still, no panic. Just a new rallying cry. Buy the dip. March 27th. Fed Chair Alan Greenspan raises interest rates again. Investors barely blink. April 3rd. MicroStrategy, a tech giant riding high, restates earnings. Its stocks plummet 62% in one day. The dam begins to crack. And suddenly, the whisper becomes a scream. People stop asking questions. They start asking for exit. Sell orders flood the system. Margin calls slam into people's accounts like a wave hitting a glass window. And the dot-com darlings, once icons of the new economy, are first to fall. Amazon drops 30% in a week. Cisco begins an 86% nosedive. Intel, Sun Microsystems, Yahoo, all crushed. Pets.com, the sock puppet mascot of the era, burns through its millions and disappears by the end of the year. By April 14th, the Nasdaq has lost 34% in just 5 weeks. $1 trillion gone. This wasn't a dip. This was disintegration. The myth of the new economy shattered. Clicks weren't cash. Eyeballs didn't pay the bills. And momentum had no parachute. The market didn't just fall. It vaporized. The crash made headlines. But the aftermath, that was quieter, longer, and far more painful. From March 2000 to October 2002, the Nasdaq didn't just fall. It unraveled. A slow-motion collapse that wiped out 78% of its value. $5 trillion in wealth gone. Cisco stock? Still lower today, 25 years later. More than 200,000 tech workers laid off. Thousands of startups erased. Dozens of IPOs from 1999 to 2000 never heard from again. For everyday investors, 401ks shrank, IRAs cratered, and the retirement they've been told to expect drifted further and further away. But it wasn't just the money that disappeared. It was the belief that the system would protect them. Companies folded in weeks. Office furniture was left on curbs. Startup founders went from magazine covers to bankruptcy court. But here's the cruelest part. The people who lost the most weren't reckless. They were responsible. They followed the advice. They maxed out their 401ks. They trusted their advisors. They bought the index fund. They held through the dip, just like they were told. They weren't chasing the hype. They were following the plan. And that plan betrayed it. Because once again, just like 1929, just like 1987, the ones left holding the bag were the ones who stayed the longest. They didn't just lose the money. They lost the future because no one told them how to protect it. History doesn't repeat itself, but it rhymes. Once again, markets are roaring. But underneath the numbers, it's not growth we are watching. It's belief swelling to the surface. AI stocks explode. Nvidia hits $4 trillion market cap, the first stock in history to do it. Reddit IPO surges 85%. Bitcoin blast past 100,000. New meme coins gains 1,200% in a week. TikTok influencers, YouTube streamers, and Twitter threads scream hot tips, while stock tickers and crypto charts spin in the background. Sound familiar? It should, because we've seen this movie before. Companies with no profits commanding sky-high valuations. Day traders swapping stock and crypto tips on Reddit, Discord, and X. Startups and tokens going public or launching, not because they are ready, but because the market is desperate for a story. Back then, it was .com. Now it's AI and crypto. Same plot, different costumes. In 1999, they said, clicks are the new cash, eyeballs are the new earnings. Now they say, tokens are the new value, data is the new oil, and this time, it's different. Maybe it is different. Maybe the technology has evolved. But belief without structure, it's still just speculation in 4K. And here's the part nobody wants to admit. The more things change, the more investors start betting on momentum instead of math, on narratives and stories instead of numbers, on hope instead of history. And when the music stops, it won't be just overhyped stocks that vanish. It will be the portfolios, retirement plans, family legacies, built on trust in a market that was never built to catch them, unless you built a structure that doesn't need the market to survive. When the Nasdaq fell 78%, when $5 trillion vanished into digital dust, when retirements, college funds, and dreams evaporated overnight, the wealthy didn't scramble to recover because they weren't playing the same game. They were not chasing .coms or IPO euphoria. They were already moving deliberately into protection-first strategies, private assets, structured notes, dividend-paying whole life insurance. Not flashy, not speculative, but safe. But here's what they didn't have back then. A modern IUL, Index Universal Life, as we know it today, didn't fully exist in the early 2000s. If it had, it might have been the single most powerful tool for surviving the .com collapse. Why? Because a properly structured IUL offers something Wall Street can't. Market-linked growth without being in a market, a 0% floor, meaning you never lose in a crash, tax-free growth and income, no RMDs, no penalties, no IRS share. Inside an IUL, your money isn't riding the market. It's linked to it with guardrail. So when the next bubble bursts, you don't get wiped out. You get a flat year. Then you keep growing from a higher floor than everyone else. While others are recovering lost ground, you're already building forward. That's the power of structure. And while the wealthy didn't have access to IULs like this in 2000, you do. You don't need to ride the market to build wealth. You need to protect what you've already earned and grow it on your own terms. Quietly, tax-free, crash-proof. Most investors never saw it coming in early 2000. Even fewer had a way out. Now you do. Your next step? See exactly how this strategy could work for you. Try the IUL Custom GPT, your private AI-powered strategist. It answers the questions your advisor won't. How much can I contribute? What happens in a bad year? How does this compare to my Roth or solo 401k? Ask any question, see real-world examples, model your strategy in seconds. And the link is in the description below. It's instant, it's confidential, and it's built for people who want more than a guesswork. Bull runs come and go. Crashes come fast. But your future should be built on something that outlasts them both. If you thought 2000 was bad, wait until you see what broke in 2008. It wasn't just a crash. It was a near collapse of the global financial system. And just remember, it's not what you earn, it's what you keep. Enjoy the ride.